Before I start, I want to say a few things. I might say a few things um, uh, which may be sort of out of the realm of things we talk about, particularly in front of administrators. And the point is not to poke holes at anyone. The entire idea of having this discussion is to look at how we practice medicine, how we manage our money from all angles, and how it affects our practice, and how we find more enjoyment and fulfillment in our medical careers. So that's the idea. I'm also filming another video which is entirely on the psychology of personal finance. I'm not going to talk a whole lot about psychology. I'm going to treat this as the science of personal finance, but both of them are intertwined. I think that'll be done by next week too. So I'll send them around when they're ready. In all our presentations, we put this disclosure slide, and never is it more relevant than on a topic like personal finance, because I'm not here to sell a product. I'm not here to get commissions on anybody's money. And I think that's the problem in the finance industry, is that when you talk to an advisor, no matter how they're getting paid, there's always an incentive for them to tell you what you want to hear them, so that they can have a portion of your money, whether it be commission on an hourly rate or whatever it might be. And of course, they're going to be very nice to you. They're going to meet you in a fancy suit in a nice office, because over the course of your career, it actually means hundreds and thousands of dollars for them. So as we go through this, I'm going to talk about the basics of personal finance using the Boglehead's model. I'll explain what that is. We'll talk about how to protect our assets, because as important as it is to manage the upside, we should also have a plan for the downside. And then I think understanding what financial independence means for our careers and how it helps us combat stress, burnout, and frankly find more joy in the practice of medicine, which sometimes in the quest of increased productivity gets lost, where we become sort of feel like, oh, I'm just a robot. I have to get through these many patients at clinic or these many studies throughout the day. But I think hitting your personal finance goals early in your career can make you think about what you value in life, where you find joy. And frankly, the more advanced you are in this journey, the more joyful the practice of medicine will be for you. So I think the thing that's scary about this topic is that people are like, oh, I'm not that great. I make mistakes. I've made some big financial mistakes. So I have this advisor. I trust all my money with the advisor. I know nothing about it. I'm too stressed about it. I don't care about it. It doesn't interest me. I just want to be a doctor. So, I've kind of offloaded this work to someone. And that's okay. There's problems with that. We'll talk about it. But I think the first thing I want to say is we all make mistakes, and that's okay. Even if you're not doing well in the personal finance space, regardless of where you are in your career, given that we're all physicians and high income earners, we can always catch up. So all is not lost in this space. Now, as physicians, at some point, we're all going to be pitched a variable annuity. And what it is basically it's a very complex investment, insurance, all mixed in policy. And the saying in the finance community is that these are not bought and these are sold. What essentially it means that there's hefty commissions for people who sell them, and they're not really a good product. They're very pricey, and all in all, you lose a lot of money if you get into it. So I had a fiduciary advisor. Now, fiduciary is a term where an advisor is supposed to prioritize a client's interest. And that fiduciary sold me a variable annuity very early on in my career. When I started reading about it online, I said, oh my God, this is a bad policy. I shouldn't be having it. I took one or two other finance second opinions, and ended up canceling a policy and lost $30,000 in the whole process. And I was really early on in my career and basically wiped me out. I didn't have that many savings left. And so that taught me a good lesson that I need to take care of my personal finance situation myself. And I can't really trust anyone regardless of any fancy word they use. The second big lesson that it taught me was this idea of domain dependence. What that means is that being a very smart, astute, experienced physician doesn't really translate into money smartness. And that is, frankly, these are all, frankly, two different terms, but sometimes this idea gets lost that you're an expert in one space and you think that you have the IQ to succeed in one space, so you'll be fine in another space. And if you haven't spent the time to learn, and frankly don't have the experience of doing it, you can make some really big mistakes, like I did early on in my career. So watch out for domain dependence. Now, we all know this. For those of you who are early on in your career, you might still be paying off medical education debt. The highest number that I have heard from my resident colleagues in radiology is $400,000 in debt. That's significant amount of money. And a lot of young trainees, young attendings are still carrying this debt. So this debt is not going anywhere. It's probably going to get worse. Some of us also have credit card debt. And so all in all, a lot of the money that we're making early on is going to repayment of this debt and, frankly, interest. So I think we have to acknowledge that as high income earners, as physicians, at certain point in our lives, we do get entitled, specifically when we make this transition from being a trainee to an attending. The incremental increase in the salary overnight is something that can make anybody's head spin. But with this entitlement comes a lot of problems. So the first thing we do is that we haven't really seen a paycheck. We're in early mid-30s, and we said, well, I've been deprived for so long. I'm going to buy a nice house, a nice car, and a nice car like this. And again, something really nice these days, if you want to go electric especially, can bring you down up to $90,000. That's a lot of money for something that you're just merely using to commute to and fro work. And then buying a house like this comes with a lot of problems because now, depending on how big of a house you buy, a large portion of your post-tax paycheck is going towards the house. So you're now house rich, but frankly, there's not a lot of income for you to pursue other things. And now you're probably working really hard so you can keep the house. So some things to watch out for. There's how much of a house you should buy. There's a lot of blogs on the internet, but really it's a personal decision that you ought to make very carefully. And then, of course, in the U.S., as we've seen before, house prices do crash. So if prices crash at the time where you need money or you're hoping to relocate or retire, and frankly might need the equity in the house, it might create more problems. So the big three that you have to look out for are, how big of a house you're going to buy, what are your transportation costs, and frankly, food can become very expensive if all you eat is all organic. And if you just, instead of looking at everything in your life, if you just focus on these big three, that is probably where most of your money is going. Buying an expensive shoe or going on a weekend vacation or a fancy vacation once a year, twice a year, isn't really gonna wreck your financial situation. And then these credit card companies, as soon as you get the attending check, you'll get a lot of offers in the mail, free card, fee waived for the first year, because they want you to get in credit card debt, because when you don't make your full monthly payment, they're going to charge you exorbitant amount of interest for the money that you didn't pay, 18%, 26%, whatever they feel like. And that can be a huge drain if you're not paying off your credit card debt at the end of the month. So this debt can really take you down and frankly in the opposite direction of where you want to go in your financial independence journey. But you got to start at some point. Now we all make mistakes. Everybody's situation is different. But regardless of where we are and what mistakes we've made, we can always start. We can always start. And we need to be humble about it. And sometimes we do need help. And sometimes we just have to take charge of the situation and reverse some bad decisions that we might have made. But we have to start small. So every dollar matters, especially when you're starting out. Maybe not if you're 20 years out, but initially, every dollar saved is a dollar earned. And I think we have to start thinking about different words. So when you're in training, you're thinking about, okay, what income am I going to make? But over time, this focus on income should change to what's my net worth? What's my cash flow like? What's my cash flow situation over the course of a year? Is my net worth growing over time? What is my net worth target to go maybe part-time? What's my net worth target to feel very secure and financially independent? And do I really value medicine that I'm going to keep working when it's no longer bringing joy? And thinking about at what net worth do you think you'll feel comfortable walking away from medicine as a source of income? So all of those things are really important. And I think rarely do we hear anybody who's a physician talk about budgeting. What's my budget? What do my expenses look like? Everybody is so focused on how much income can I make, and we ought to prioritize savings a lot more than at least what we talk about. So if you're still in debt, you wanna maybe learn about PSLF. There's quite a few blogs online. There's several YouTube videos online. But focus on paying the debt, and you can. Some people like to pay debt first before they start investing. Some people like to pay debt and invest at the same time. Again, it's a very personal decision. It's also a mathematical decision based on what interest rate you're paying for medical school debt. If the interest rate is really, really low, sort of below inflation rate, you could carry that debt for a while, assuming that you're doing a really, really good job investing. If you're not paying the debt and blowing through the money, it's probably easier to pay off medical school debt, and in the long run, you'll end up ahead. Now, the biggest financial decision of our lifetime, we've all already made that decision, is actually living in a high cost of living area versus a low cost of living area. So when you sign up for your job, if you're still in training, or maybe you're looking to relocate, or where you plan to retire, all of where you live is your biggest financial decision. Now, high cost of living areas are great because they're frankly areas that have better weather. They're probably coastal. You have water activities. You have hiking. You have lots of events to go to on the weekends, and it's a much more fun place. But they're also really, really expensive to live in, and also real estate is pricey. But if you go to some areas that are maybe in the Midwest where you have to kind of deal with snow, maybe those places are not more desirable, maybe the politics is not to your liking, whatever your reasons might be. But the huge advantage of living in a low-cost area is that you'll actually have a better cash flow situation, and you might be able to accelerate your financial journey. Now, not everybody is of the opinion that your house is a valuable investment. It might turn out to be. Certainly, Seattle real estate has done really well in the past, but there's no guarantees that it's going to do in the future. And the way I look at it is, I don't personally look at my house as an investment. I look at it as a place to raise my family. And if it turns out to be a great investment, I'm happy. But I'm not counting on it, but I do think that having some money invested in the real estate is good diversification. It may not be the best investment if all of your money is in real estate, but having some of it is actually a good idea. Now, as you try to pay off debt, there's two different strategies. The first strategy is the debt snowball effect, where it actually doesn't make a lot of mathematical sense. It's more a psychological hack, where you look at all of the debt that you owe and start paying the smallest debt first. Now, what that does is if you've paid off two of your smaller debts first, suddenly your brain thinks, oh, I'm done with 50% of my debt because I have these 4 areas of recurring debt, and I've already paid off 2, and that gives you more motivation to maybe try and make a bigger dent on some of the larger debt that you're carrying. And then the debt avalanche method talks about how you can pay off your debt with the highest interest rate first, and this makes more mathematical sense, but it's a little more defeating in the psychological sense, because you may be paying off a lot of money, but the number of debts that you hold are not really decreasing. So depending on how you think about it, either of these methods might be a better fit for your situation, but continue to at least make minimum payments so that you don't incur a crazy amount of fees, especially on the credit card side. Now, how do you start building wealth? So if you can avoid lifestyle inflation and live like a resident for the first couple of years, that is going to be your biggest bet, because that really turbocharges compounding in your favor. And if you kind of slowly grow into a more attending lifestyle rather than overnight shifting into one, that might help you too. The other thing that I really prioritize is that when I get my paycheck, I look at the money in my account and say, okay, I know I have some bills to pay, I have a mortgage to pay, but how much of this money am I going to pay myself for my future self? And then immediately invest that money so that, by the second day, I only have enough money sitting in the account for my day-to-day expenses until I get the next paycheck. But there's really no more financial decisions to be made at that point and until the next paycheck rolls around. But I think if you're a little bit behind, or you're stressed out, or medicine, the joy of medicine is maybe dying inside of you, or maybe you're itching to go part-time and maybe pursue some of the other outside work interests that you have, then you might want to pay a little bit more attention to the FIRE community. And what the FIRE community is all about is that we've had a very robust economic growth since the 2008 crash, where a lot of people are making a lot of money in the stock market, and frankly, some of them have been retiring early, and they have been writing about it. And there's different ways to look at what FIRE actually means. For some people, they want to make work optional. For some people, they find a lot of joy in work, and so they want to make retirement optional. Some people want to say my lifestyle is fully funded until I die because I have enough money that I can take 2 trips to Europe and do whatever else I want. And for some people, they're like, okay, I never have to think about money ever again. I'm just going to do what I love doing, and until I can't do it anymore because now aging has caught up with me. So there's different ways on how you can think about it, but maybe you want to retire early, or maybe you want to think of coming to work as a fun activity, and it's a really nice headspace to be in. Now, that being said, as you start your financial journey towards this goal, the first thing I would say is, before you start investing in the stock market, and as we're talking about this, S&P is down 1.5% this morning. It might become challenging if all your money is going down, because rather than going up, you're starting to lose money in the stock market, at least on paper. that you first save a 3 to 6 month savings of your living expenses in what's called an emergency fund. Now, what's an emergency fund? So you kind of dig into this fund if you have, say, flooding in your basement, or if your roof needed replacement, or some unexpected medical bills happened. So where should you put this money? Now, if you go to a regular bank, like a brick and mortar bank in your neighborhood, I looked into Bank of America. Their certificate of deposit is giving 0.06% return on a 13-month CD. I mean, that's so low, I wouldn't even bother. But if you actually go to an online bank such as Ally Bank, they're actually giving 10 times that. So even though it's a very low 0.6% for a 12-month CD or a high yield savings account that they're offering, it's at least 10 times more than the brick and mortar banks in our neighborhood. So there's so many options. Decide which ones works for you. There's pluses and minuses for each one of them, which I'm listing here. Where I keep my emergency fund is I actually invest that money in municipal bonds. They actually pay the same amount as a high yield savings account, about 0.6%. But returns on municipal bonds are tax free. So even if I'm making very little money on them, at least I'm not paying income tax on the municipal bond income. And it takes about 2 or 3 days to break those municipal bonds and get it into your checking account if you were to need the money. But until that happens, you could always use your credit card, I suppose. The only thing is there's very small volatility in municipal bonds if the stock market were to experience a very severe crash. But for the most part, they're reasonably stable. So that's what I do. So this is something we all need to understand, that especially when you're younger and you're like, oh my God, I see my older colleagues talk about how many millions of dollars their estate is worth, and I'm doing the same job, I'm working as hard as them, but nothing seems to happen in my portfolio. And that's because saving your first million is really, really hard. And it can actually take a few years. Now, this is an example from a blog where somebody is saving a lot less money, frankly, than what a physician should be able to save. But suffice to say that it's going to take a few years to get to 1 million. Now, once you get around that number, what actually happens is that this compounding really kicks in, because if you've made if you've saved up to $1 million and you have that amount of money invested in the stock market, and the S&P or your portfolio did 20%, now suddenly you've seen $200,000 increase in your portfolio, even though you haven't moved a finger. But if you're early on and you only have $20,000, 20% of that really isn't going to be as exciting for you to watch. So keep the faith, keep pushing. As the numbers become bigger, you're going to see a lot of momentum in your overall net worth growth, especially in the years where the stock market does really well. Now, let's talk about why Boglehead's strategy is the strategy that is a better fit for most physicians. Now, all of us are really busy. We frankly don't have the time to research stocks, what kind of stocks to buy, when's the right time, what's the PE ratio, what are the returns like, how the fundamentals of the company are. And frankly, it's gambling, because stocks can actually go down even when the company is doing well because they didn't meet the expectations of the stock market pundits. So none of us have the time to do that. If you want to still invest in individual stocks, my suggestion is to have no more than 5% of your overall portfolio in stocks. And as you see that you're actually doing worse than the S&P index, try to gravitate away from stocks. What Boglehead's strategy talks about is, this was started by John Bogle, the founder of Vanguard, is that the focus here is on your net worth. You invest on a periodic basis, say 1 to 3 times a month. You invest in a well-diversified portfolio. You only take as much risk that can make you sleep peacefully at night. If you're invested very aggressively and you're having trouble sleeping at night, then you need to dial down the risk. You need to understand that most of our returns in the market are actually driven by less than 10 days where the market moves significantly, and how we behave in those handful of days is really going to make a huge difference in our financial outlook at retirement. And then we use index funds in this style. We keep costs really, really low. We have our investments in different accounts in the order that we're minimizing taxes. We're using the tax code to our advantage. So things that give a lot of dividends are to be invested in your 401k. Things that you think will do incredibly well or are very aggressive should be invested in your Roth IRA accounts and whatnot. And regardless of how the stock market does, you really stay the course. So out of all the blogs that I've seen online, I think this post by Mr. Money Moustache blog is the most incredible post that I have ever seen. It's been life-changing for me personally. And what this does, it actually shows you on the left side what's your percentage of saving of your income and how many years you need to work until you hit retirement or financial independence, whatever your goal might be. Now, I know this is really, really hard, but look at this number here. If you are actually able to save 60%, I know it's hard, but people do it and it can be done. You can be done from all money issues in about 12.5 years. Now, this teaching that in the finance industry that save 10 to 15% of your money every month and you're doing great. Well, if you save 10%, you're supposed to work for 51 years to reach your financial independence numbers. If you start at, let's say 35, at that, you're working well into your 80s. That's not exciting to me at all. So the harder you work on your saving side, not so much the income, but like how much you're saving, that's going to have the most impact, because as you try to aim for jobs that lead to more income, there might be inflation, like lifestyle creep that you don't notice. You might start driving a better car or living in a better house or taking fancier vacation, but and really going down on this sliding scale. So what you really want to keep an eye on is how much you're saving, and look at this table often. I just love this. I think this is my favorite blog post of all time in the personal finance space. So I wasn't convinced that this math was accurate. I have a scientific mindset. I was like, where are these numbers coming from? They don't look very realistic at all, whatever said and done. So I went to this calculator. It's called Networthify, and I put in an annual income of $300,000, and then I gave it some numbers, and I said, okay, if at that income you save 60%, what happens? And really, that table is actually mathematically correct. So another financial calculator that I really, really like is this calculator called FireCalc. Now, in the finance space, past performance is not predictive of future returns. We all know that. But it helps to run some numbers based on your goals, how much money you need and how quickly you can retire. That all depends upon how much money you intend to spend in your retirement. And the biggest variable in that are your medical costs. So, and then of course, how long you're going to live. And frankly, you'll be asked that question when you meet your financial advisor, and it's kind of laughable, but it's also like, there's so many variables that you can't control. But what I really like about this calculator is that if you actually put in your numbers, it actually runs simulation to give you an idea of how many times your model is likely to fail. What's your percentage of success? So just something to play around with as you're maybe deciding on what goals you're going to aim for. Another thing that I wanted to show is that I track my finances on the Excel version on Apple called Numbers, and I was looking at my numbers, and on the left side are on this light blue column is the value of your portfolio, and these are in $1 million, and you can see that as the stock market does. Percentage growth wise, how quickly your portfolio will grow, especially when the portfolio becomes bigger. So just to give you an idea, if let's say you're 20 years out in practice and you have $6 million invested, and the stock market just does 6%, well, guess what? You've made $360,000 all savings, maybe a little bit of tax on the dividends that you got, but pretty much for everything you can keep. And that's the value of compounding and starting really early on this journey. Like the quickly you get to these numbers, the better off your financial outlook is going to be. So when I was starting out, the thing that I found most paralyzing was, how do I design this portfolio? And so you meet an advisor. The advisor really wants you to do what they believe in, and how much of a risk you're willing to take in the market is very different from what the advisor is comfortable with. And frankly, I don't want them to touch my money. I just want them to give the advice if I need it. And so designing this portfolio was really, really hard, and it actually delayed my start with investing because I just was paralyzed. So a couple of things to know in this space. There's lots of surveys. I think there's a survey on the Vanguard website that you can take that allows you to assess your attitude toward risk. So how risk averse you are. That should factor in on how aggressive you are in your portfolio. You've got to literally make a decision of what your investing style is going to be. Are you going to be investing in rental properties, or are you going to go investing in the S&P index, and what kind of mix you're going to have in those investments, and how much of an asset allocation you're going to give to each area that you can possibly invest in, and how are you going to diversify to actually dial down the risk. So with that in mind, here's some models. I'm actually sharing my allocation model in this middle column here. And it's a really, really simple allocation model. The thing that I do believe in this personal finance space is that anything that you can't understand in a very simple way is a bad investment, because just don't invest in anything that you can't understand easily, because then it's so complicated that you're probably paying exorbitant fee and getting fleeced by the finance industry. So my model is, I have 55% in the US stock market, 15% of those are in small and mid cap, and mostly in some in small cap value funds. I have about 20% in international funds, 5% of those are in international small cap, 10% in real estate funds, they're called REITs, and then the rest are in bonds. And I'm aggressive because I'm 45 and I'll dial down this risk as I hit my personal finance numbers. But you want to be aggressive when you're young, because you have this ability to rebound from stock market lows. But once you're older, you have less time for this rebound to happen. And if you're very aggressive and the stock market really crashes, when you're planning your retirement, you actually might have to work for several extra years. Not a very pleasant thought, I'm sure. So moving on, why should we invest in low-cost mutual funds? So in the finance industry, there's this famous line which says, you keep what you don't pay. Basically, what it means is that a lot of investments have really high fees. Some of it are visible, like the trading fee and commissions and whatnot. But there's also kind of other hidden fee that if you actually read the prospectus of these funds, that you'll find that there's secretarial fee, record keeping fee, and all of that. And it's all hidden. And so you want to find something that you're paying a really, really low cost for. Now, let's say you have an advisor that charges just 1% of assets under management, and they're recommending or having you buy some mutual funds that also have an expense ratio, which is code word for fee in the finance industry, of 1%, and you don't think that's anything. Wait until you see this number here, that if you pay 2% in fee, by the time you retire, you've gifted them 40% of your account. And this is from Vanguard. This is not from my calculation. And so what you really want is to go invest in an index fund with really, really low fee. Now, how low? 0.05% expense ratio, meaning 5 cents for $100. That's how low of a fee you can get in today's world. It's really, really inexpensive to invest if you actually go with low cost index mutual funds. Now, if any mutual fund says active management, that means a college graduate with some finance degree that they've taken in record time are investing that fund for you, and they're picking stocks based on their whims and fancies, and they're probably underperforming. Why do I say that? Because 90% of actively managed mutual funds cannot beat the S&P index, or maybe that number is 95%, somewhere in that ballpark. So take-home points on costs. All investments have costs. There's no free investment. If you're curious what the costs are, you can read the prospectus at least once, because these costs are published. The money you lose is not just the money, it's also the money you lost that had the potential to compound over time. The low-cost funds, believe it or not, actually do better than the high-cost funds, especially the funds that are actively managed. The passively managed funds that are just linked to the index do a whole lot better. And then there's lots of hidden fees that you don't see, so you have to be mindful of that. The way I think about money is that you actually have three buckets or three colors of money, however you want to think about it. The taxable amount, the taxable account is the most valuable because that actually you can withdraw at any time, but it's also the most leaky in a way that you're actually paying dividends as you go along, tax on the dividends that you're going along. The tax deferred, the 401k, the 403b, the 401a accounts that we have, these accounts, we haven't paid taxes on them, so we'll be paying taxes when we get older. So they're also leaky in some way, but there's also the tax-free accounts, which are the Roth accounts. And those Roth accounts, you can be very aggressive in those. And so because you've already put in money in those accounts that you've paid taxes on, and you hopefully will never pay taxes on them ever again unless the tax laws change. So this is a list of like how much money you can put away in 2021. In several, you have to like max the 403bs, the 401as, and the HSA accounts by the end of the calendar year. But you can actually do your backdoor Roth IRA until tax filing day. And then if you have any extra income from outside of work, you can actually consider opening up an LLC, which gets you access to additional individual 401k that has a much higher limit on the amount of money you can tax defer. So just putting in a little bit of learning in how you can invest in any outside income is actually very advantageous to your tax situation and also on how quickly your portfolio will grow. So these are your tax deferred accounts on the left side. Most of us have any or all of these. The SEP IRA or the individual 401k are only for those who have taken the effort of setting up an LLC and do have outside income from maybe consulting, medical legal work, or grand rounds or whatever generates money for you. Then anything that is Roth is tax-free. Health savings account is actually a triple tax advantaged account because you never paid any money, any tax in this account with money going in. And as long as you use this money for health reasons, you never paid tax on it. The only caveat in using this account is that the deductibles are high. So you end up ahead in the years where you didn't have any significant cost in terms of health expenses. But if you were to have surgery in a year, probably that year you would not come out ahead. As a young family, we invest in a health savings account. And some years where we have healthcare expenses, we don't do great. But in most years, this works out in our favor. If you're looking for financial calculators, my favorite website is this website with a funny name. It's called dinkytown.net, but it has some really awesome finance calculators. The one that I would recommend looking into are the mortgage calculators. So let's say you took out a $500,000 mortgage for 30 years at 3%. If you just paid $500 extra per month into this mortgage, you can be done. You can shorten the length of your mortgage by 8 years. So that is something to consider. Not for everyone. The current mortgage rates are really, really low. So you may or may not want to do it, but you have the option if you wanted to. The other thing to understand is that if you took out a mortgage of $500,000, the real cost of your loan is actually $771,000 accounting for interest. So don't overlook the interest, and these amortization calculators actually show you how much you're actually paying. Let's dive down a little bit deeper. So month one, you're actually paying quite a bit more interest in your mortgage payment and very little principal. So if you are going to put down money, extra money towards your mortgage, it actually makes a lot of sense to put that down early. And if you're not going to do that and you have a really old mortgage that's like 20 years out, look at these numbers towards the end of your mortgage payment. You're paying such little money towards interest that the banks have already charged you the interest up front. So if you have an old mortgage, I don't see a whole lot of financial sense in paying off that mortgage, especially if you're the interest you're paying the bank at that point is so ridiculously low. So I think how the mortgage payments work is really important to understand. This is a little bit more advanced, but you definitely want to spend some time thinking about where you're going to park your money in terms of tax efficiency and in what account. I don't have the time to get into this, but this slide has everything that you'll need. The column in the middle can go on either side, depending on how much space you have. But on the left are the things that you definitely want to put in your taxable account. And the tax inefficient ones are basically the ones that give dividends. And they should be at least put in your 401k or 401a or 403b accounts. But bottom line, you got to keep it simple, right? You really can do tremendously well if you just invest in a three-fund portfolio. You don't actually need to be fancy. The fancier you get, you're probably taking a hit on your returns. And you can rebalance with every monthly contribution towards your portfolio. If your portfolio is about 5% off, you might want to consider rebalancing. But you don't have to rebalance more than once every 1 to 3 years is the recommendation. So this is something which everybody ought to take a look once. That there's going to be a lot of crashes. There's going to be a lot of world events that'll affect your portfolio. But over the course of 30 years, which is the time that you start making income to the time you stop earning from your regular job, you will almost always end up higher. Now, if the fabric of the world economy collapses, that might be different, but you got to be at least that optimistic, right? So again, even at 10 years, there's no guarantees that you'll be coming out ahead, maybe not even in 20. But if you stay invested, you're going to do really, really well. And then there's also this element of luck or timing. So if you start at the bottom of the market, I started as an attending in 2009 at the bottom. So anytime I invested any money, it did great. Does that make me an amazing investor? No. That just tells me that luck kind of worked out. But for luck to work out, you have to be in the market and you have to spend time in the market. So this is one of the things that I don't think many physicians do. This is something to consider. This is called an investor policy statement. This is like, it's very short. This is sort of how I do it. And what you want to do is you want to write down how you're going to behave when the market is being turbulent. So rather than make decisions on when you're really, really emotional and stressed out, you want to plan out these decisions really early on, when you're kind of relaxed, chilling out on the beach. Decide what you're going to do when crazy things happen. So this is called investor policy statement. Disability, well, you ought to have a disability policy so that you have a rider that pays you if you can't practice dermatology. For me, radiology. And these are some of the riders. You can pause the video when we send it to you and call your disability policy guy and say, do I have these riders? And make sure you have a good disability policy. Life insurance, the only policy you should end up buying is a term life insurance policy, and you can cancel it after you hit your personal financial numbers. You definitely want to have a will and an estate plan, because the state will take over your minor children if you don't have this done. And this is called probate, and this is a very, very expensive process. I don't have time to get into the tax code of like what happens when you have a side hustle, but here's the article. It actually has a table of the tax situation for somebody who has outside income. And then burnout is more common than you think. Like, these are some of the radiology numbers. They're frankly scary. I suspect numbers in dermatology are similar, but you can actually find joy in your financial journey, because it allows you, this financial journey, if you're doing it really well, allows you the opportunity to job craft. Maybe you can stop taking call for, or stop taking shifts around the holidays and just say, I'm happy to take the pay cut. I want, 1 month unpaid leave every year, however you want to change your lifestyle. These are the 3 books that actually got my money mindset right. Highly recommended that you read, a couple of these to get the idea. But really, these are the big 4. You need to protect your downside. You need to invest in your taxable accounts so that you can actually retire early or have some flexibility. If you have any outside income, you want to optimize it for retirement purposes. And you really want to spend some time optimizing your investments so that you're not paying a whole lot in tax, more than you ought to. So adopt a net worth mentality, not an income mentality. Focus on cash flow every month. Invest early, protect your assets, and then focus on using all this knowledge to improve your wellness. That's the big idea here. And to improve your wellness, you have to become financially literate, right? That's the idea. And I've actually started a YouTube channel where I actually make videos on all of these soft skills that we need in medicine, things about burnout, things about how to navigate mid-career issues, how to become more creative. There's a webinar that I sent earlier, so you get to hear from 3 people and not just one, the same things that I talked about. If you have leadership ambitions, you can talk about how to plan to be chairman. It's not for everyone. There's also a video on how having pay equity has a huge impact on staff motivation, and also some productivity topics. And
very positive enthusiasm in the chat. obviously you're making this actual video available via YouTube is the plan, it sounds like, huh?
Yeah, and there's another one that's focused on psychology, which is a summary of the 3 books that I talked about. So there will be 2 videos in the next by the end of next week for sure.
That's great. We'll have Amy pass those out and share them in our Derm Blast and other formats. But I really think it's so important to think about how money interacts with happiness and our sanity these days.
Yes.
It's an important balance. Thank you so much. I'm not sure if there are specific questions people want to raise.
Okay, I'm seeing this question about where I got that table. Michi answered the question. It's Mr. Money Moustache is the blog. The posts are really small in that blog. That is my favorite post, but he has several other posts that are really interesting. And it's an interesting blog about this person who actually doesn't spend a whole lot of money on things in life, and he uses his bike to commute around and do groceries, so that gets him exercise. And he blogs about how little money he spends on his food, a real minimalistic model. And I think the point of that is not denial. The point of that is to have more options for your future, right? So it's a balance. Not everybody wants to go minimalistic. But if you're very consumer oriented, you're paying a price in terms of wellness and burnout and whatever else, and kind of like not setting up yourself for financial success in your retirement for sure. I'm happy to take on any more questions.
Hi. This is Jay Berry. Thanks very much. I had one comment based upon the video when I watched it on Monday that was sent out in advance, and I have invested a lot in TIA CREF because as a public employee, that's a real good option. Yep. But their fees are really high, which I had no idea. I hadn't really even looked into it and compared it until I watched your video. So thanks very much for at least waking me up to that. And then the other comment I'll make, which I realize is somewhat controversial, is that I think one of the poorest investments you can make is to have kids too. So financially, they're a huge drain. Certainly, they may or may not come with other benefits, but I think when you list your big 3 things to think about when you're finishing residency, I think kids should be on there too. Because if you send your kids into childcare and private school, that's at least $500,000 a kid over their education.
I agree. The reason I didn't have kids in there because kids to me, like as a personal philosophy, were not really optional. I like. They bring so much more joy than money could ever bring. Yes, but mathematically you're right. And so, talking about fees, we're doctors, right? So we like things that can screen, right? Screening tests, right? So I actually, for fun, I designed a personal finance screening test. So whenever I get into a discussion about personal finance, I ask the screening questions, and the question that I came up with is, I ask anyone, just tell me name of one ticker symbol and its expense ratio in your portfolio. For somebody who's like, who has knowledge in this space, they would know that a ticker symbol is like VTSAX or any name for any mutual fund. That's the ticker symbol. And an expense ratio is actually the fee. So, but if you've not spent the time to dive down in your investments, then you probably don't know how much fee they're going to charge you because that's not written up front. And you have the option of, I believe, moving money from your TIAA CREF to Fidelity or Vanguard or some other funds. But that's a little bit of work on your part. But again, if you've been investing in TIAA CREF for many, many years, a sizable portfolio, the fee, the amount of money you're going to save in the fee annually, and plus the compounding that the fee that you're going to save is going to be tremendous, right? And so I have so many horror stories that I've heard from my colleagues who sometimes will reach out to me for help. I had a colleague who never invested because She lost some money in the 2008 stock market, and she reads MRI better than anybody else I know. So she's wickedly smart, but she doesn't invest at all, right? So that to me was shocking, and I couldn't get her to change. She's paranoid. And another story that I found was I asked somebody wanted help, and they were also in TIAA CREF, and I said, okay, you'll have to show me how you're doing stuff before I can help you. So we log in. First of all, that person couldn't find the password, which means they hadn't logged in years. Once we were able to get in, 100% of the money was invested in Europe. So I explained diversification and whatnot, and designed a model for my colleague. And 3 months later, I said, okay, so how are you doing now? So he said, oh, because I've been invested for the last 10, 15 years, 100% in Europe, I figured that I should spend the next 15 years in investing in the US stock market and completely get out of Europe. So I was like, oh my God, you really didn't learn. You got to be diversified, right? So I think, some of us learned this really easily, and for some of us it's hard, but for none of us is this material actually optional if you think about it, right? So you just have to push through.
Thank you. And we're speaking of wellness. We try to end our conferences, give people a couple minutes before the hour. So I'll say we can sort of semi-officially end here. People run off to your next meetings. Jordan, you've got one question. Why don't we pop that in, and people can feel like they can run off to the next Zoom if they need to. Go ahead, Jordan.
Okay, thanks, Pete. That was great. I read Boggle's The Little Book of Common Sense Investing years ago, and one of the things that I remember, and you touched on it by showing us that if your fee or your expense ratio is 2%, you'll lose 40% of your account value over time. And what I took away from that book was, rather than get a financial advisor, maybe just buy index mutual funds, maybe just one, and put it all in there, and let the best 500 companies over time, get you your return and don't pay any fees at all. I'm wondering, if you think that's sound advice, or it is sound to find, a financial advisor with a fee that's 1% or less. Thanks.
Yeah. So if there are people who just put all their money in the S&P index fund, and that's okay. These 3-fund or 5-fund portfolios that I was showing, they're a little bit more tax optimized in the sense that if you're 100% in the S&P stock market, and the stock market went down 20-30% like it did last March, you can't really rebalance because you don't have any bonds, right? So that's an opportunity lost if you have a portfolio like that. But I think over time, you'll do fine if you just did that. It's just that with the 3 or 5-fund portfolio, you can decrease your tax costs by hiding the dividends in these tax sheltered accounts and all of that. So there's nothing wrong. I think to each his own. Some people want the simplicity, some people want the tax optimization, and the more advanced you are, the fancier you can get. But beyond a 5-fund or 6-fund portfolio, like really there's no additional gains, and an S&P index would also be fine with just the lack of tax optimization.
Thank you so much, Puneet.
Okay, thank you.
Check you out on YouTube.